Imagine it's 1975. You're 65 years old, and today is your last day of work. Your coworkers gather around with a cake, a handshake, and a gold watch. After spending nearly 4 decades with the same company, you walk out of the building knowing something most Americans today can only hope for. Next month, and every month after that, a retirement check will arrive in your mailbox. You don't need to study the stock market. You don't need to worry about whether the S&P 500 crashes next year. You don't need to ask yourself if you've saved enough. Your retirement has already been taken care of. Now fast forward to today, a 65-year-old American isn't celebrating freedom from work. Many are staring at a screen, checking the balance of their 401k, wondering if they can actually afford to retire. One market crash, one bad investment, or simply starting too late can completely change the next 20 or 30 years of their life. So what happened? How did America go from a retirement system built on guaranteed income to one where millions of people are expected to become investors just to stop working? The answer isn't just about pensions or 401ks, it's the story of one of the biggest financial shifts in American history, a shift that quietly transferred retirement risk from some of the largest corporations in the country to ordinary workers without most people ever realizing it. To understand how that happened, we have to go back to an America that almost feels impossible today. After World War II, the United States entered one of the greatest economic booms in its history. Factories ran around the clock, manufacturing jobs paid enough to support entire families, and loyalty between employers and employees was rewarded instead of questioned. If you worked for companies like General Motors, Ford, US Steel, or thousands of other major employers, retirement wasn't something you had to build by yourself. It was part of the deal. Every year you stayed with the company increased the pension you would receive after retirement. The company carried the responsibility of making sure that promise was kept. Workers didn't spend evenings comparing ETFs or calculating how much they needed to retire. Their biggest financial strategy was simple: show up, work hard, and stay loyal. That promise created a level of certainty that's difficult to imagine today. Families bought homes, raised children, and planned decades into the future, believing that retirement wasn't a gamble. It was guaranteed. But while millions of Americans were living that dream, a financial problem was quietly growing beneath the surface. The longer people lived, the longer companies had to keep paying them after retirement. At first, few people noticed the pressure building. But by the 1970s, that pressure would grow into a crisis that forced corporate America to rethink retirement forever. And the solution they found would completely change the financial future of every generation that followed. By the early 1970s, the cracks in America's pension system were becoming impossible to ignore. For decades, pensions had worked because the economy was booming. Workers often spent their entire careers with one employer, and retirees didn't live as long as they do today. But America was changing. Inflation reached levels families had never experienced before. The oil crisis sent energy prices soaring. Foreign manufacturers, especially from Japan and Europe, began competing with American companies that had once dominated the global market. Suddenly, businesses weren't just trying to sell more cars or appliances, they were fighting to survive. At the same time, medical costs continued to rise, and Americans were living longer than ever before. That might sound like good news, but for companies with pension plans, it meant paying retirement checks for 20 or even 30 years instead of 10 or 15. Every employee who retired became a long-term financial obligation sitting on the company's balance sheet. To investors, those pension promises looked less like employee benefits and more like massive future debts. Executives who had once proudly offered guaranteed retirements now began asking a different question: how long can we keep paying for this? For the first time, the retirement system that had helped build the American middle class was starting to look financially unsustainable for many corporations. Then something happened that almost nobody outside the financial world paid attention to. In 1978, Congress passed a tax law containing a small provision known as Section 401k. It wasn't front-page news, and it certainly wasn't introduced as a replacement for pensions. In fact, very few people imagined it would change retirement at all. But a handful of benefits consultants and business leaders quickly realized the opportunity hidden inside that law. Instead of guaranteeing workers a monthly income for life, companies could allow employees to save part of their own paycheck into a tax-advantaged investment account, often matching a portion of those contributions. From a corporate perspective, it was revolutionary. The company no longer had to guarantee a lifetime payment regardless of what happened in the economy. Its responsibility became limited to making contributions while the employee was working. Everything after that, The investment returns, the market risk, and ultimately the size of the retirement fund would largely depend on the employee. It seemed like a smarter, more flexible system for businesses facing an uncertain future. But while companies saw lower costs and reduced risk, very few workers realized what had quietly changed. Retirement was no longer becoming something your employer promised. It was becoming something you had to build yourself. And over the next 2 decades, that single shift would completely redefine what it meant to retire in America. Throughout the 1980s and 1990s, the change happened so gradually that most Americans barely noticed it. One by one, companies began freezing their pension plans or closing them to new employees. New hires were offered a 401k instead. On paper, it sounded like a modern upgrade. Instead of being locked into one company for decades, workers could take their retirement account with them wherever they went. Employers often matched part of their contributions, and because the money was invested in the stock market, many financial experts argued that employees could actually retire with more money than a traditional pension would have provided. For a while, it looked like everyone was winning. Companies reduced billions of dollars in future liabilities, employees gained more flexibility, and Wall Street welcomed millions of new investors into the market. The message became simple. You don't need a company to fund your retirement anymore. You can build your own wealth. It sounded empowering, but hidden beneath that promise was a responsibility previous generations had never carried. For the first time in modern American history, ordinary workers were expected to make decisions that had once been handled by professional pension managers. How much should you save? Which funds should you choose? How much risk is too much? When should you move your money? One wrong decision, or simply starting too late, could mean working years longer than planned. And that's where the biggest difference between a pension and a 401k becomes clear. A pension promised an outcome. A 401k only offers an opportunity. Under the old system, if the market crashed, the company was still legally responsible for paying your pension. Under the new system, a market crash could erase years of your retirement savings overnight, and the loss was yours, not your employer's. In exchange for greater freedom, workers also accepted greater uncertainty. Some Americans benefited enormously. Those who invested consistently stayed in the market during downturns and started saving early, often built retirement accounts worth well over $1 million. But millions of others weren't as fortunate. Some delayed saving because everyday expenses came first. Others panicked during financial crises like the 2008 recession and sold their investments at exactly the wrong time. Many simply never learned how investing worked because nobody had taught them. Retirement had quietly transformed from a company guarantee into a personal financial exam, one where every American received the same test but not the same education. And that raises the most important question of all. Did replacing pensions with 401ks actually create a better retirement system, or did it simply make retirement cheaper for companies while becoming far more complicated for everyone else? That answer is what ultimately defines whether this historic shift was a financial breakthrough or one of the greatest transfers of risk in American history. So, was America better off with pensions, or is the 401k actually the smarter system? The truth is far more complicated than most headlines make it seem. If you had asked a factory worker in 1975, the answer would probably have been simple. A guaranteed paycheck for life meant peace of mind. You didn't have to predict the stock market, worry about recessions, or become an investment expert just to retire with dignity. Your employer carried that responsibility because they had made the promise. But that security came at a cost. Pension plans became incredibly expensive to maintain, especially as people lived longer, healthcare costs increased, and businesses faced fierce global competition. Many companies simply couldn't afford to keep making promises that stretched decades into the future. The 401k solved many of those problems. It gave workers ownership of their retirement savings, the freedom to change jobs without losing their retirement account, and the opportunity to build significant wealth through long-term investing. For disciplined investors who started early and stayed consistent, the results could be extraordinary. In many cases, a well-managed 401k could outperform what a traditional pension might have paid. But unlike pensions, success was no longer guaranteed. The system rewarded financial knowledge, patience, and consistent saving, qualities that not every worker had the opportunity to develop. And maybe that's the biggest lesson of this story. America didn't simply replace one retirement plan with another. It changed the definition of retirement itself. For decades, retirement was viewed as a responsibility shared between employers and employees. Today, it's largely viewed as a personal responsibility. Whether that's progress or not depends on who you ask. Some see the 401k as one of the greatest wealth building tools ever created, giving ordinary Americans access to long term investing that previous generations never had. Others argue that it transferred billions of dollars of financial risk away from corporations and placed it on workers who were never fully prepared to manage it. The reality is that both views contain truth. Pensions offered certainty but little flexibility. 401ks offer flexibility but demand discipline. Neither system is perfect, but understanding why America made this shift helps explain why retirement feels so different today than it did 50 years ago. The next time someone tells you that retirement is simply about saving more money, remember this. The biggest change wasn't how Americans saved. It was who became responsible if the plan failed. That single shift reshaped the financial future of millions of families and remains one of the most important economic changes in modern American history. If you understand that change, you don't just understand pensions or 401ks, you understand how the American dream itself quietly evolved.